Every year, without fail, the markets give investors a gift, and most of them don't even recognize it. That gift is volatility, specifically seasonal volatility, the kind that shows up on cue, rattles portfolios, floods the headlines with fear, and then quietly fades. If you know what you're looking at, these moments aren't threats, they're opportunities, and the investors who learn to use them are the ones who build real, lasting wealth. Today, I want to talk about the intersection of two disciplines: understanding seasonal market patterns and mastering the patience required to act on them wisely. Because the truth is, you can know all the patterns in the world and still blow up your portfolio if you haven't built the discipline to go with them. Let's break this down. Markets are not random noise, they have rhythms. The well-known sell in May and go away pattern has been studied for decades. Historically, U.S. equity markets have produced their strongest gains between November and April, and their weakest, most volatile returns between May and October. Researchers have tracked this pattern across multiple decades and across international markets, and while no pattern is perfectly consistent, this one has shown remarkable persistence. Then there's the September effect. September has been, on average, the single worst month for stocks going back over a century, not because anything catastrophic happens every September, but because of institutional behavior. Mutual funds close their fiscal years in October, triggering selling pressure. Summer liquidity thins out, portfolio managers reposition. It's structural, it's recurring, and it's predictable. Add to that the election cycle. Markets historically show above-average volatility in pre-election years as policy uncertainty peaks. Factor in earnings season windows in October and January, Fed decision cadences, and commodity swings tied to seasonal energy demand. You start to see a picture emerge, not of chaos, but of rhythm. Now, I want to be careful here. These patterns are not a trading playbook. They're not a signal to liquidate every April and reinvest every November. Markets evolve, correlations shift. The investor who tries to time seasonality precisely will lose far more than they gain. But as context, as a framework for calibrating expectations and preparing your mindset before volatility arrives, they're invaluable. Here's the problem. Most people know volatility is coming, and they still react emotionally when it does. We saw it in the summer sell-offs. We see it every time geopolitical headlines hit in August, or when September rolls around and every financial media outlet starts recounting historical declines, as if reminding investors to be afraid. And it works. Investors who were perfectly calm in January suddenly become anxious in September, even when nothing fundamental has changed in their portfolio, their time horizon, or their financial goals. Why? Because volatility feels personal. A 10% drawdown looks very different on paper than it feels in your stomach at midnight when you're checking your brokerage account. In those moments, the brain isn't running a discounted cash flow analysis. It's in survival mode. The amygdala, the part of the brain wired for threat detection, doesn't distinguish between a bear attack and a bear market. And when fear takes over, investors make predictable mistakes. They sell quality positions at the worst possible time. They move to cash and miss the recovery. They chase the next safe narrative, only to buy back in at higher prices after the volatility has already passed. Here's the painful irony. Most investors don't lose money because of bad markets. They lose money because of bad reactions to markets they should have expected. This is where patient investing stops being just a philosophy and becomes a genuine competitive advantage. Patient investing is not passivity. Let me be very clear about that. Patient investing is prepared investing. It means you have already decided, before the volatility hits, what your plan is. You know your time horizon. You know your risk tolerance. You've built a portfolio aligned with your long-term goals, not your short-term emotions. And crucially, you've identified in advance the conditions under which you will act and the conditions under which you will not. Think of it like a surgeon. A great surgeon doesn't walk into the operating room and improvise. They've studied the case, prepared the environment, anticipated complications, and positioned themselves to execute with precision. Patient investors operate the same way. They study the historical patterns. They prepare liquidity, what some call dry powder. They build a watch list of quality assets they'd love to own at the right price. And when seasonal weakness creates genuine value, they deploy capital, not because they're guessing, but because they've done the work ahead of time. Warren Buffett didn't build Berkshire Hathaway by panicking in September. He built it by showing up in September ready, with cash, conviction, and a long-term view that made short-term noise irrelevant. The best investors I've worked with over 25 years all share this quality. Not brilliance, not insider information, discipline, preparation, and the ability to stay calm when everyone around them is not. So how do you actually build this into your investment process? Start with a seasonal calendar. Map out the historical volatility windows relevant to your portfolio, equity markets, fixed income, commodities, whatever your exposure looks like. You're not predicting, you're preparing. Second, build a wish list. What are the positions, funds, or asset classes you'd want to add to if prices pulled back 10 to 15%? Have that list ready with target price ranges before the volatility hits. Decision-making under pressure is always inferior to decision-making made in advance. Third, review your liquidity posture entering historically weak periods. This isn't about going to cash. It's about ensuring you have the capacity to act opportunistically if conditions warrant. And finally, review your behavior, not just your returns. After every bout of volatility, ask yourself, did I follow the plan? Did I make decisions based on strategy or emotion? Where did fear show up and how did I handle it? That honest self-assessment is how you get better. Here's the framework I want you to walk away with. 1. Know the seasonal patterns. Not to trade them, but to contextualize volatility when it arrives. Don't be surprised by what history has already told you to expect. 2. Build your plan before the storm. Asset allocation decisions made in chaos are almost always wrong. Make them in calm. 3. Define your entry points in advance. Quality companies, diversified strategies, long-term positions. What would you buy if it went on sale? Write it down now. 4. Review your behavior, not just your balance. The investor who understands their own emotional triggers is the one who stops repeating the same costly mistakes. And 5. Trust the process. The investors who build generational wealth aren't the smartest traders in the room, they're the most disciplined ones. Volatility is not your enemy, impatience is. The market will test you every single year. The question isn't whether the test is coming, it's whether you've studied for it.